All right.
Now you can start.
Good morning, everyone. I, CA Ayushri Khanna, a member of Panipat branch of NIRC of ICAI, welcomes you all in the webinar, which is Valuation Marathon Session number 10, which is on the topic Discounted Cash Flow Methods, organized by Valuation Standard Boards of ICAI, definitely under the chairmanship of dynamic leader CA Hansula Chubsar and vice chairmanship of leading lady CA Preeti Paris. We are going to have our brilliant speaker, CA Gaurav sir, for the session, and he is going to share all his knowledge regarding cash flow methods. As I'm going to introduce him later on regarding his professional achievements, and you'll be amazed to know that he's so experienced at this age. So before we start officially, regarding the topic, I request Hansraj sir to please welcome the audience.
Thank you, Ayushri. Good morning to one and all the participants. My best of the speaker available with us today, Gaurav Sukhija ji. He'll be deliberating upon discounting cash flow method under the valuation system. My co-chairperson, Preeti Savla, from Mumbai, western part of the country, you see like West is always considered to be a financial hub or the economic hub for the country. A dynamic chairperson, she is from that part. Ayushri Khanna, the moderator of the program, my team from the committee, Rahul ji, tech team also. You see, like this program once conceived to every week we have to bring out some program which is giving a strength and the knowledge, and understand knowledge is the power. And with that methodology, Preeti, and we thought of bringing out every Sunday 10 to 12. Though naturally Sunday was been a best considered for many reasons, because Sunday normally we talk about we will get up late and so many things. So now in the professional system, it's not like Sunday or the Saturday or any other day. Every day considered to be amongst the best, because there is no variance between the days. Nowadays, that is the thought process. And this program as such, a weekly program, which we called is a Valuation Manthan, which is gaining popularity all across. Today is the 10th session in the system in the row, and going forward, many will be there in the time to come. The objectivity behind and the purpose behind is rightly said by Ayushri, also spoken with. So basically, to make it more giving the best of the knowledge on the different area means whether it is starting from the startup front point of view, or going forward from the under the regulation system, any valuation required, or the unregulated mechanism which is for the purpose of the commerce and the business. Methodology, different methodology is being adopted with. It is not at the national level. We have a standards with us, which has been given by the Valuation Standard Board, and the which has been made compulsory for the those who are the members of our fraternity of the chartered accountants, which is well approved by the Council of the ICI. Moreover, we have a international valuations also, which ICI is a part of as a member of the International Valuation Council also. So understanding goes with we have not to limited our knowledge to the national level. We have to go forward with the gaining best of the knowledge from the overseas standards also, standards which are not applicable overseas also, international also. With those kind of understanding, this program is being brought in front of each one of you, and hopefully all the participants, which runs into the thousands, they are always inspired. Many comments come to our team and to me also, my co-chairperson also, this is the best program brought in by the Standard Board. So that keeps us motivating to do other on the other parameters also, which we have to work on, which Preeti Savla, our co-chairperson, will deliberate upon, how this board is been taking care of this profession of the valuation side, so that we ultimately run into the objective of finding a best of the with the ICI for many parameters for many regions. It's not limited to the valuation of the first level, but business of a highest level or the mechanism of the regulation or the unregulated system. So with this initial remarks, I once again welcome each one of you, each and every participants, my speaker of the day, Gaurav Sukhija ji, moderator of the program, Ayushri, and the team at the tech also and team at the secretariat, Rahul also with us, and my co-chairperson, Preeti Savlaji. Now I'll request Preeti Savlaji for her initial remarks and the keywords for the to understand it's better. Preeti, over to you now.
Very good morning to all of you, respected Chairman of Valuation Standard Board, CA Hansraj Chuk, the speaker, CA Gaurav Sukhija, the moderator, CA Ayushri Khanna, and all participants, seniors, and my dear members. Sunday morning, tea time, and bedtime, and we are having this valuation. And today, the 10th, we have completed. Today is like a first decade kind of thing we are completing, and 10th session, and very important DCF method, which is the mandatory one of the mandatory method of valuation. And we have very good speaker for the same, and already about 1000 participants have already joined, and we all are very eager to hear Gauravji. And Gauravji, it's a tough time, and I'm sure everyone will be justified after this session. And friends, Hansraj Bhai has said that I am sharing with all of you some of the initiatives, and he has put me into the some situation which I can say that I am only speaking, our chairman is doing, and I am speaking like that. So very dynamic, under the very dynamic leadership of Hansraj Bhai, I can say that our board is functioning like as very well. And friends, I want to share with all of you, as I said last time also, we are coming up with the standards on plant and machinery and land and building very soon. And Google form also will be out, as we have discussed in our meeting also. So I request office to please bring out this Google form and the members who are interested, and this should be circulated to all the participants which are there today as well as in last 9 episodes also, so that the members, if they are interested in framing these standards along with the faculties, can please give their names. We will make a group. The office will make a experts group on this, and to bring out this draft valuation standard on plant and machinery and land and building. And the process will go on through the council for approval. And let's see, we are planning to bring out this standards in this year. This is our agenda and action plan also. So working towards that, along with various other things, we also want to have some RRC on the valuation, and very soon that also will be coming out with best of the structure and faculties. So stay connected, stay in touch, mark your calendar, block your time every Sunday morning, valuation Manthan with tea time. Once again, welcome all of you to this standard valuation Manthan series, and over to Ayushri. Thank you very much.
Thank you so much, ma'am and sir, for your words. And, personally, I believe whenever I'm moderating such webinars, like I did it once 2-3 weeks back, I guess, for valuation, I believe this is a kind of eye-opener Sunday. We, get to know lots more about ICI, valuation and all. And it's like you both are bringing best speakers to us. And the Sundays are also productive. I never believed that Sundays could also be that productive. So thank you so much, authorities, to give us this opportunity. And I believe that participants will also agree on this. So without taking much of your time, I'll introduce our speaker, CA Gaurav, who is a registered valuer and a partner in corporate finance and consulting practice of PGSJ and Company. He's a chartered accountant based in New Delhi, and he is a valuation expert. If I talk about his career, he has performed over 500 valuations, and that's too much looking at your age, sir, spanning a range of industries including IT, deep tech, D2C product, and many more. If I talk about corporates and startups, that is also not behind. He has worked with Paytm, Jindal Steel, Dish TV, and many more. So if I'll introduce you in much more detail, I think time will be short to you to explain the topic. So without taking much of the time from participants, I request CA Gaurav sir to please take the stage and introduce your concept. We are just eagerly waiting to hear and learn from you. Over to you, sir.
Thanks a lot, Ayushri. Thanks a lot for a wonderful introduction. And I'm, humbled, and I am, obliged to the whole team here who has allowed me to give the presentation and, tell people about what discounted cash flow method is and about various aspects of valuation. First, I would like to thank and welcome CA Hansraj Chugji, who is respected chairperson of Valuation Standard Board and the most humble Central Council member I have met on various occasions. I've been associated with Hansraj since since I was doing my GMCS back in 2012 or 13. And when Sir used to be an IRC member, and we've seen his humbleness, we've seen his politeness since then. So thanks a lot, sir, for giving the opportunity and creating this dais for allowing us to speak. Next, I would like to thank CA Preeti Paras Savla ji, who is also co-chairperson. I am, stunned to listen about the achievements and the contribution, ma'am, which you are giving to the, institute and to the community as such by helping women chartered accountants, entrepreneur to, grow, and then alongside also helping the Valuation Standard Board in developing this practice for a long period of time. Now I would like to thank C. Ayushri Khanna, who is, wonderfully moderating the session until now, and and is also very well dressed, to be honest. So, last but not the least, C. Rahul ji, he has been, a regular support to the to this session. He has been calling, he has been talking, he has been asking about things on regular basis. So thanks a lot, Rahulji, for your contribution and to the tech team. Cutting short, coming to my presentation now. So, yeah. So discounted cash flow method. See, we'll be talking very candidly. I have few models also, which I will be demonstrating. It will be a very practical session. I'm not talking about anything theoretical. I'm not talking about anything different. So, anything that is, you would not like to hear, you would not like to understand, or something which is, you say ki either bookish hai. So it's not like that. It's all about my experience, which I've done altogether. So first though Ayushri has already told about me, I'll just tell something that लोग valuation भी करते हैं, मैं valuation ही करता हूँ, तो एक ये difference है. So I have been part of Deloitte team in valuation. I've been part of SS Kothari Mehta's team in valuation, and I could serve best of the best in the organization, in the team. I've worked with a lot of startups. I've worked with corporates. I've worked with manufacturing, D2C sector. So you'll find a lot of experience coming in from various aspects, things like that. So to start off, valuation as a topic, how do we do valuation? सबसे पहला क्वेश्चन ये आता है कि यार गौरव एक वैल्यूएशन आई है, कैन यू प्लीज टेल मी हाउ डू आई अप्रोच दिस प्रोसेस? सो द प्रोसेस इज वेरी सिंपल. What you do is you first go on with a analyze and perform historical data. It's not just about projection. When we do any valuation, the projection should be based on the past performance of the company. It shouldn't be dependent upon the just their aspirations. It shouldn't be dependent upon their budgets. It shouldn't be dependent upon other things. It should be dependent upon the historical data. So first, what we do is we analyze the performance of the company. We talk to them, what kind of business do you do? What kind of things you're doing? What kind of business you're doing? What are your monetization things? And those kind of things, we talk about. We'll talk that in detail as well. Then we broadly analyze the financial forecast. See, analyzing the financial forecast is ideally not the responsibility of a valuer, but it is a duty of a valuer definitely to check the projections which he is basing upon. He's basing his opinion upon. See, valuation is a very, very subjective matter. It's not just about what valuation you give, it is about what numbers you're using. It is about what weighted average cost of capital, what uh, projections you've used, what terminal value you have used. There are various pillars which we'll be talking about once the valuation is done. It is, a very pragmatic approach to do that is send across a draft report to the management, so that if they need any change in the cosmetic changes in the valuation, like for example, writing something better about the business description of the company, or maybe talking a little more about the industry, or some basic aspects of the regulatory thing which they may need, or their legal team may need, or the regulatory team may need, you may like to help them in doing so. So it's important to send them draft report of the valuation. But mind it, sending the Excel working is not compulsory. People ask for Excel working on regular basis. It is a practice at Big Four. It is practice at all big organizations who are doing valuation that we do not send Excel working. So why we don't send Excel working is there are various reasons for that. But let's not delve upon that. But it's very simple that you send them draft report, because they should be, considerable about only report. They shouldn't be considering about what valuation, how the valuation was conducted, what kind of parameters were used, and those kind of things. Because valuation is a subjective matter, and it is our analysis, it is our thought process which we work upon. So hence आप उनको Excel working देंगे, वो और delve upon करेंगे, they will ask you to do this and do that. So do not work upon valuations wherein a valuation has come to you. Work on valuations where you have to do a valuation, because there you add value. So try to add value to the organization rather than just covering upon the regulatory aspect कि sir इतने में transaction हो गई है, valuation दे दो. So generally it is not advisable and shouldn't be done, and it's not legal to do valuations wherein the valuation has been established by the company altogether. All the statutes, whether regulatory statutes, whether talk about FEMA or SEBI or income tax or Ministry of Corporate Affairs, Ind AS, it says the transaction should be based on the valuation. It shouldn't be the otherwise, wherein you are you're putting the valuation on the basis of transaction. It shouldn't be like that. You should also conduct industry research, then conduct valuation using appropriate approaches, and then prepare valuation report and discuss the results with the management. So that's the whole process which we generally follow. There are different methodologies. We'll be delving upon discounted cash flow, to be honest, but there are different methodologies to be followed. One is cost approach, was net asset value method. It's generally used in those companies which have just started, maybe, when you do not have good projections of the company is pre-revenue, company does not have anything, and it's basically, maybe raising funds at par value. So you can definitely consider net asset value as one in the case of startups. But if it is not a startup and it is a very high capital intensive project, in that case also you can use net asset value method, or you can use a replacement value method or realizable value basis. So it can be adjusted NAV also. So there are few cases when the holding company is getting valued, but the holding company's actual value is coming from the subsidiary company. So what you do is you put a DCF on a subsidiary or any other method to a subsidiary company. You put that valuation of the subsidiary company into the NAV method of that company. Now, because that company does not have any business and is only an investment holding company, you can definitely use adjusted NAV method in those cases. Then comes market approach. There are market price method, which is generally used in SEBI, 60 days average or 120 days average. So those kind of methods are there. It's generally basically for listed entities. Then comes comparable company multiple method. It is EV, EBITDA, EV revenue, profitability, P by BV in case of. So CCM is also very tricky. We'll talk about in some other session for sure, that it's not just about EV, EBITDA, EV revenue methods. It is dependent upon the industry you are working on. It can be EV per bed for a hospital. It could be EV per key for a hotel. It could be P by BV, that is price to book value for a debt for an NBFC or a bank. It could be EV revenue for a company which is EV GMV for a company which is just doing gross merchandise value and doesn't have any revenue per se, or have very less revenue. So the comparable company multiple is also very vast. Then coming to comparable transaction multiple method, it's also, comparing the transactions which are there in the industry and talking about those. The last and the best method which is ideally used for discounted cash flow method. See, until now, under the Income Tax Act, under Section 56 to 7B, which has now been amended by including the non-residents also in the regulatory framework, there have been changes in Rule 11 UA. So, Section Income Tax Section 56 to 7B, when read along with Rule 11 UA, it says that a valuation should be performed by discounted cash flow method. Now, a valuation should ideally be done by a discounted cash flow method, but there are new methods also which have been introduced via Rule 11 UA. But you can understand discounted cash flow was used for a very long period of time and will also be used for a very long period of time, because discounted cash flow is the only method in the whole industry which actually talks about a scientific method of valuation using many pillars of doing the same. So there was a PwC research also. Primary valuation approaches remain the income approach and market approach, which I've already talked about. Net asset value has very, very less application. The journal indication from the respondent is that they did a small research that income approach remains the primary valuation methodology used by 58% of the respondents. So they did a research to check people are using discounted cash flow method, or they're using market approach, or they're using NAV. So they understood that, basically 42% are actually using the other methods, and 58% people are actually using discounted cash flow. That makes the importance of this session today, that what is a discounted cash flow method. हम लोग बहुत सालों पहले जब SFM पढ़ा करते थे, मतलब हम सबने पढ़ा है SFM, उसके अंदर हमें टाइम वैल्यू ऑफ मनी पढ़ाया जाता था. द होल कॉन्सेप्ट इज टाइम वैल्यू ऑफ मनी, नथिंग एल्स. हमें कहते थे आज हम किसी को 100 रुपए दे दें, वो 10 साल बाद हमें 100 रुपए वापस करेगा, क्या उस 100 रुपए की वैल्यू वही होगी? तो हम कहते हैं नहीं, उस 100 रुपए की वैल्यू वो नहीं होगी. तो वो हम लोग जो इतने सालों से पढ़ते आ रहे हैं, वो ही मेथड को कहते हैं डिस्काउंटेड कैश फ्लो मेथड. इसके अलावा और कुछ नहीं है डिस्काउंटेड कैश फ्लो में. हाँ, अब क्योंकि वो 100 रुपए नहीं है, हम ये बात करते हैं कि यार वो आज 100 रुपए है, उसके ऊपर 10-10% का इंटरेस्ट आएगा हर साल. हो सकता है 8 हो सकता है 10 हो सकता है 8 हो सकता है 10 हो, तो परपेचुटी तक जाएगा. सो डिस्काउंटेड कैश फ्लो मेथड कैन बी यूज्ड फॉर 2 डिफरेंट सेट ऑफ कंपनीज. वन इज अ प्रोजेक्ट बेस्ड कंपनी. प्रोजेक्ट बेस्ड मतलब मान लो माइनिंग का किसी को कॉन्ट्रैक्ट मिला है. अब माइनिंग का कॉन्ट्रैक्ट 15 साल के लिए मिला है, तो आप जब डिस्काउंटेड कैश फ्लो लगाओगे उनके लिए, तो आप परपेचुटी तक वैल्यूएशन नहीं करोगे. आप उतने ही प्रोजेक्टेड फाइनेंशियल्स तक यूज करोगे जितने आपने नॉर्मली यूज करने हैं. सो वील डेल्व अपॉन दैट इन फर्दर सेशंस. सी, डिस्काउंटेड कैश फ्लो का हमारा जो एक प्रोसेस होता है, दैट इज बेसिकली फर्स्ट वी टॉक अबाउट डिटरमिन फ्री कैश फ्लोज टू द फर्म. उस पर भी हम आगे बात करेंगे, अभी मैं बिल्कुल समराइज तरीके से बात कर रहा हूं. देन वी डिटरमिन द एक्सप्लिसिट पीरियड, देन वी टॉक अबाउट वेटेड एवरेज कॉस्ट ऑफ कैपिटल, देन वी डू टर्मिनल वैल्यू, देन वी डू present value of cash flow from explicit, and then we go to valuation using DCF method. सबसे पहले हमें इंफॉर्मेशन क्या मंगानी है एक डिस्काउंटेड कैश फ्लो वैल्यूएशन करने के लिए? तो हमें चाहिए एक तो लेटेस्ट ऑडिटेड फाइनेंशियल्स विच एवर आर अवेलेबल. मे बी इट्स अवेलेबल फॉर 31st मार्च. अभी करंटली अगर वैल्यूएशन कर रहे हैं 30th अप्रैल पे या 31st मई पे, तो हो सकता है 31st मार्च 23 के ऑडिटेड फाइनेंशियल्स अवेलेबल हो. अगर नहीं अवेलेबल है तो एनुअल फाइनेंशियल्स प्रोविजनल तो ले ही लेना, मतलब 31st मार्च 23 के, एंड ऑडिटेड फाइनेंशियल 31st मार्च 22 के. Then if you're doing valuation on 31st May, let's assume, or you're doing on 30th April, you take provisional financial as on the valuation date. Then you take projected profit and loss account of the company for a period of 5 years. See, sometimes what happens is, like for example, if you're doing in May, you've already covered 2 months, you're left with 10 months only. So you will ask them for 10 months and 5 years. You should always try covering a 5-year period for projected financials. 5 years are very important because that actually covers a cycle for all the company. So why do we talk about only 5? We don't talk about 7, we don't talk about 10. You should ideally understand that these numbers are 5, 7, 10 are basically the cycle of the process. वो cycle के अंदर पहले grow करेंगे, फिर वो हो सकता है बेस लेवल पे है, फिर थोड़ा सा डिक्लाइन करें, फिर दोबारा ग्रो करें. तो वो पूरा का पूरा जो सेगमेंट है वो आपके 5 इयर्स 7 इयर्स के अंदर जनरली कवर हो जाता है. 10 इयर्स तक नहीं जाना चाहिए, क्योंकि जो आप वेटेड एवरेज कॉस्ट ऑफ कैपिटल लेते हो वो 5th ईयर में जाके वैसे भी 0.49 0.51 के आसपास या 0.6 के आसपास आ जाता है. तो There is no use of valuing a company wherein you're using a discounted cash flow method and you are, just using 50% of that value to doing the valuation of a company. It's better to put it into perpetuity and move forward. So there are different ways to do that. Coming next is anticipated working capital and capital expenditure over the forecast period. So that's also very important. Then fully diluted shareholding pattern as on valuation date. तो अब ये बड़ा इंपॉर्टेंट एक सेगमेंट है. तो फुली डाइल्यूटेड शेयर होल्डिंग पैटर्न होता क्या है कि कई लोग सिर्फ जब शेयर होल्डिंग पैटर्न मांगते हैं तो उनसे मांगते हैं इक्विटी शेयर. फिर क्या होता है अभी nowadays there are a lot of securities like for example compulsory convertible debenture, optionally convertible debenture, compulsory convertible preference shares and things like that. So हमें उनसे fully diluted shareholding pattern मांगना है. हमने उनसे ये मांगना है that you tell me that if your company is having CCDs or CCPS or things like that, you should ideally show the whole shareholding pattern to me and should also include the ESOP pool in it. So ESOP एक ना pool बनता है. So there is an ESOP pool which is, let's assume they have earmarked 10,000 shares for ESOP. अभी उन्होंने उसमें से ग्रांट सिर्फ 1,000 या 2,000 ही करे, बट वो पूरे 10,000 को हम अपने फुल्ली डाइल्यूटेड शेयर होल्डिंग पैटर्न में रखते हैं. सो फुल्ली डाइल्यूटेड शेयर होल्डिंग पैटर्न इज इंपॉर्टेंट. व्हाट इज नॉट इंपॉर्टेंट इज इक्विटी शेयर होल्डर्स. हमें सिर्फ इक्विटी शेयर होल्डर्स के बारे में नहीं पता करना है. जब भी हम बात करें उनसे पूछें दैट डू यू हैव एनी कन्वर्टेबल सिक्योरिटी, डू यू हैव एनी कन्वर्टेबल नोट, do you have you already filed an EGM or a board meeting for for an ESOP, do you may be having any optionally convertible debenture. So वो सारी की सारी चीजें एक बार कंफर्म करके then you go on fully diluted shareholding pattern. So these are few things. Coming to discounted cash flow as such, so there are 4 pillars of discounted cash flow method. The first pillar is projections. आपके पास सबसे पहले प्रोजेक्शंस आती हैं. आपको पता लगता है कि प्रोजेक्शंस कहां से आई, कितनी आई, क्या आई, उसके ऊपर कैसे करते हैं. दैट आई delve upon in the further slides. Second comes a discount rate. Discount rate is not just about weighted average cost of capital. It can be weighted average cost of capital. It can be cost of equity. It can be yield. While you're doing valuation, it could be debt yield which you're using. So there are different discount rates which are used for different kind of companies and for different kind of cash flows which we are considering. Then comes terminal value. Projection हो गई, discount rate हो गया. यहां तक हमारी assumptions हैं. Terminal value भी एक बहुत important assumption है. Ideally, in most of the valuations, you will find around 50% of the value comes from terminal value. Sometimes it is also 60%, 70%, sometimes it is 30. So it ranges between 30 to 60% for a terminal value. तो अगर इतनी ज्यादा value terminal value से आ रही है, and most of the valuations which I have reviewed. So, if you want to do a regular check on valuation, or you want to learn valuation, or you want to read valuation reports as just as an understanding as a learning, there is a regulation under NOC under rule regulation 37 जो बॉम्बे स्टॉक एक्सचेंज की वेबसाइट पे और नेशनल स्टॉक एक्सचेंज की वेबसाइट पे अवेलेबल है. आप वहां पर जाके देख सकते हैं दैट एनी मर्जर और डीमर्जर दैट इज हैपनिंग, for that valuation reports are being uploaded there on regular basis. So any merger of a listed entity or in merger involving a listed entity is happening, wherein maybe an unlisted entity is being acquired or something like that. तो वो सारी valuation reports वहां पे available होती हैं. You can go and check on regular basis. So when I've seen those kind of valuation reports, I've seen a lot of errors there also. Errors on the terminal value. This is the most common error which people do. Last but not the least is the after adjustments. After adjustments is not about buy value 300 आ रही है इसको 400 कर दो. It's basically not like that. After adjustments are basically about the cash, the surplus assets and things like that. So I'll delve upon all the 4 pillars in my presentation. So the first and foremost is the projection. So projection के लिए आपके पास एक projection आई कंपनी की and they say गौरव इस पे इस पे वैल्यूएशन करके दे दो, and I really don't want any discussion upon projection or something. That just say no to the valuation in that case. First and foremost which you need to do is you need to do a common sizing. What is common sizing is आपने एक रेवेन्यू को बेस बना लिया या जीएमवी को बेस बना लिया या नेट रेवेन्यू को बेस बना लिया आफ्टर रिमूविंग द अदर इनकम. उसको बेस बना के आपने एक कॉमन साइजिंग करी कि सारे जो पैरामीटर्स हैं वो पैरामीटर्स आपके किस परसेंटेज पर आ रहे हैं. अगर आपका एबिटा मार्जिन, अभी रिसेंटली आई वाज डूइंग एन ऑडिट रिव्यू फॉर वन ऑफ द ऑडिट क्लाइंट ऑफ आवर्स, wherein उनका जो EBITDA margin है वो FY24 में 5% था, and that was increasing to around 18% by the FY28 or 29. So I was amazed to see that how can this kind of growth be there from 5% to 18%, or there was another set of valuation, another set of company who was moving from current zero, rather negative losses, to 32% in FY28. So sometimes it is also possible that the company is currently doing a lot of marketing and things like that, and they're developing a market and they know that this segment can have this kind of an EBITDA margin. तो उसके लिए हम लोग क्या करते हैं? We do an industry trend analysis. In the industry trend analysis, we check whether the common sizing which they're talking about, अगर वो आज कह रहे हैं कि वो 5 साल बाद एक EBITDA margin 28 या 30% का कमांड करेंगे, तो क्या इंडस्ट्री उतना EBITDA margin कमांड करने की बात कर रही है? Is it talking about that kind of things ki मान लो for example there was a company which was into recruitment, so we did valuation for a company which was in recruitment. Currently they were not making profits because they were a startup and they were doing less business. So they came to us and they said, we wanted a valuation because we're getting funded from US and those kind of things. So we said, okay, we'll just check the valuation and things like that. They were actually talking about an EBITDA margin of 50%. When I went back, and this is a profitable industry already. It's not like the industry is not profitable. Naukri.com is profitable in it. Jeevansathi.com is profitable. The Monster.com is profitable in it. You can also look at unlisted companies, what kind of EBITDA margin they're doing. You can delve upon them through Ministry of Corporate Affairs and just looking at those things. So that's very important, and you can ideally do that. Post that, in the industry trends, so they were ideally talking about 50%, but the industry was talking about just 30%. So that was a kind of a thing which had a red flag on it. So I went back to them and I asked them, sir, please try and see that you are doing something wrong here in your projections. You're talking about 50% margin, but the companies have already doing really well in this industry are only and only doing 30%. It could be 30 to 40 maybe, but it couldn't be 50% as a profits which you can ideally command. So that's not the right thing to do. There was another very interesting valuation I did. It was for a company who was manufacturing aeroplanes. तो बड़ा अच्छा था, उन्होंने क्या करा, उन्होंने एक वैल्यूएशन के प्रोजेक्शन हमें बनाकर दिए और उन्होंने बोला कि हम हर साल अप्रोक्सीमेटली कुछ एक नंबर के वैल्यूएशन, कुछ एक नंबर के एरोप्लेन्स हम लोग डेवलप करेंगे. तो हमने कहा अच्छा ठीक है, हम इंडस्ट्री चेक कर लेते हैं एक बार. हमने इंडस्ट्री देखी तो हमने देखा कि करंटली अगर मान लो इंडस्ट्री के अंदर 1 लाख एरोप्लेन है, तो इंडस्ट्री जो ग्रो कर रही है वो अप्रोक्सीमेटली 10% से ग्रो कर रही है. तो हमने कहा अच्छा ठीक है, अगर इंडस्ट्री 10% से नहीं 5% से ग्रो कर रही थी एरोप्लेन इंडस्ट्री. सो हमने कहा अगर एक इंडस्ट्री 5% से ग्रो कर रही है तो आइडियली इसके अंदर 5,000 एरोप्लेन की रिक्वायरमेंट है हर साल. आपका जो करंट परसेंटेज मार्केट शेयर है इस इंडस्ट्री के अंदर वो 2% का है अभी. तो अगर आप 5,000 की ग्रोथ वाली इंडस्ट्री के अंदर हो, अब इंडस्ट्री को तो आप आइडियली चेंज नहीं करोगे. ऐसा तो कुछ नहीं कर रहे कि आपके प्लेन के कारण आज मैं भी प्लेन में चलने लग जाऊंगा, तो ऐसा तो नहीं हो रहा. इंडस्ट्री तो वही है जो 5% से ग्रो कर रही है, वो शायद 7% से ग्रो कर जाएगी, इससे तो कुछ होगा नहीं. तो और प्लस जो हमारे पास बेसिस हैं हम उन्हीं को मानेंगे, उसके अलावा तो हम मान नहीं सकते. सो आई वेंट बैक टू देम एंड आई टोल्ड देम दैट यू आर एक्चुअली टॉकिंग अबाउट डेवलपिंग 1,000 एरोप्लेन्स पर ईयर, which is you are commanding upon 20% of the market share altogether, and you're currently at 2% market share. Are you saying that when the industry will grow, I will of the new aeroplanes, because आप बेचोगे क्या, न्यू एरोप्लेन ही बेचोगे, इंडस्ट्री ओवरऑल तो न्यू एरोप्लेन की बात हो रही है. तो आप कह रहे हो आपका अचानक से मार्केट शेयर 20% हो जाएगा, which is ideally not possible. So these kind of industry trends are very very important. लोग क्या करते हैं, लोग अपनी एस्पिरेशंस दिखाते हैं इन अ प्रोजेक्शन. यू नीड टू शो बजट, यू नीड टू शो टारगेट. मैं सामने वाले को कहता हूँ, कभी मुझे कॉल आती है गौरव प्रोजेक्शंस बनानी है, सो आई टेल देम सर मैं बना दूंगा, इट्स आइडियली बेनिफिशियल फॉर मी टू डू थिंग्स एंड क्रिएट प्रोजेक्शंस फॉर यू, बट मैं चाहता हूं पहले आप बनाओ, आप अपने बजट्स बताओ, आप अपने टारगेट्स बताओ. मैं जो प्रोजेक्शन बनाऊंगा वो एस्पिरेशनल नहीं होगी, वो होगी जो आपको हेल्प करेगी हर बार वापस जाने में और सोचने में कि मैं ये वैल्यूएशन क्यों नहीं, मैं ये नंबर्स क्यों नहीं अचीव कर पा रहा. अगर इस साल मैं 100 पे हूं तो शायद आप कह रहे हो मैं 1,000 पे पहुंच जाऊंगा, अगले साल पहुंच जाओ, नो प्रॉब्लम, बट वो आपका टारगेट होना चाहिए, आपकी एस्पिरेशन नहीं. आप 1,000 में पहुंचना चाहते हो तो कम से कम 800 तक तो पहुंचो. दैट्स वेरी इंपॉर्टेंट टू सी कि आप उतना ग्रो कर रहे हो नहीं कर रहे हो, आप कहते हो आप एबिटा पॉजिटिव हो जाओगे विद इन 3 इयर्स, तो आप कम से कम एबिटा के -1% के नंबर पे तो पहुंचो 3 साल के अंदर एज अ बजट और अ टारगेट. सो इफ यू आर डूइंग दैट यू कैन डेफिनेटली लुक इनटू थिंग्स. सेकंड इज, जब भी आप प्रोजेक्शंस देखते हो, जनरली क्या होता है, वैल्यूएशन की एक कंपनी के साथ आप काम कर रहे होते हो, तो वो आपके पास बार बार आते हैं. अब वो जब भी आपके पास आएंगे, यू विल आइडली have their old projections also available. So what you can do is just look into the new projections which they've sent across, go back to the old projections, check what is the difference in the projections which you're talking about. And if there is a certain change altogether, you can just, there is a change which is very, very evident. You can just go back to them and ask them, ki, sir, the projections which you have given last time, maybe an year back or 2 years back, also had numbers for 25, 26, and 27 FY. And now when you're talking about 24, 25, 26, 27, 28, तो वो numbers बहुत अलग है. तो उसका क्या reason है? So there may be some reason which they're talking about, but there may be a lot of reasons which they are not talking about and just creating a projection. So do not ever just do the valuation basis, whatever projections you get. Do valuation on the basis of projections you are getting and you are actually talking about. Uh, yeah. So next is that initiating coverage report and analyst report. So there are a lot of initiating coverage reports which are available in the industry, such as when you're talking about the industry, if when I was talking about the let's talk about healthcare industry. In that case, I was recently doing a valuation for one of the company which is a good brand available in the market, and it's running a new hospital, and they came up to me that we are raising funds from currently healthcare industry and hospital industry is quite booming in the segment of fundraising, Temasek and TPG and very big OTBP, these Ontario Teacher Pension Fund and all of these, they are doing wonderfully great. Recently we got a news that Sayadri Hospital in Pune is also doing 750 crore rupees into this line. So what you do in these cases when you get a valuation of, let's assume, a hospital segment, you just go to initiating coverage reports of the listed companies. So like, for example, Apollo is a listed company in this line. Medanta is a listed company in this line. There are a lot of initiating coverage reports which actually talks about the projections in the industry and of the organization as well. So what you need to do is you can just go back, check the initiating coverage reports, see what kind of growth these companies are talking about. Just plot them in, plot 5, 6 initiating coverage reports, see what kind of year-on-year growth they're talking about. And once you talk about those year-on-year growth patterns and things like that, you will have a lot of basis to talk about your projection is not right, your projections are not setting up as per the industry, your projections EBITDA margins are not talking about. There may be fixed asset movements in the projection also. So in the projections, what are the most important things to look at is the revenue. How is the revenue being grown? So if there is a growth driver per se, if there is not a growth driver, we need to ask them that what are you currently talking about? So I'll just talk about a valuation which I have done. So the valuation, if you will see, I generally do the P&L movement as well. So like, for example, this company had a revenue growth of 100% in the first year, going forward at 13%, then 18%, 18%, 318% in October 21. These kind of questions we generally go back and ask the client that what kind of revenue margins are you talking about? Then there is a COG, that's percentage of revenue, which they're talking about 88%, 93%, goes down to 68, then 93, 69, 91, 89, 88, 69, 80. So these are, sometimes there are some cyclical change which they're talking about कि इस महीने में सेल कम होती है, तो इस महीने में जो हम प्रोडक्ट बेचते हैं, the products which we are selling in these months are basically those which are less of a cost. We do not sell those products which have higher cost in these time. There are gross profit margins. You talk about a gross profit margin of 31% in 1 year, 12% in another, 32%, 7%, 31%, 9%. It's not, these kind of numbers cannot generally work upon pre-marketing EBITDA margin. Then you talk about marketing expense as a percentage of revenue. If you'll see 13%, 4%, 3%, 9%, 1%. These kind of numbers, these are the numbers which you generally ask them that why are you talking about these numbers while you are doing a kind of a work, you're doing a projection, why are you talking about these numbers? This kind of cyclical movement cannot be there. So we generally go back and ask them and those kind of things. And then there are various projections which come to us wherein the company is not doing revenue as of now. I have seen companies like, for example, I can name, it's a public known information, is that Apna INC, if anyone of you have heard about, which is unicorn right now. It's in the recruitment sector. It's a non-revenue, zero revenue. It was zero revenue till the time they were actually zero revenue. I'm not just talking about GMV zero. I'm not talking about net revenue zero. I'm even talking about the gross merchandise value was zero. So those kind of things were there, and they are a unicorn right now. So they were getting valued at that amount of time. There can be various methods to do the valuation in those cases. It could be EV per user, it could be EV per, it could be comparable transaction multiple, but in those cases, projections basis valuation should ideally not be done. So even if you're doing a projection basis valuation, there should be a specific initiating coverage report and analyst reports, which should be there to compare, because they do not have any historical numbers. They just have expenses on their numbers. They may have users. So what you can do is you can ideally go to naukri.com and see that what is the number of users they currently have and what are they earning from the paid users, what are they not earning from the paid users. So those kind of things are very important. Some projections, when you come across, you need to see what is the total addressable market of that industry. So total addressable market is what, like for example, you are talking about maybe a gaming sector in the industry, yeah, and you are saying that you develop games. So I'll show you evaluation for a games also. I've done kind of a thing for your weighted average cost of capital and those kind of things. So I'll be showing that gaming company's valuation. So what happens in that case is, when you are doing gaming company's valuation, you look at and you ask them what is the total addressable market in this case. They say maybe the total addressable market in the world maybe around 15 billion or maybe 30 billion as an industry. So I go back to them and I ask them that if it is a total addressable market in the industry is 100 billion or maybe 20 million or maybe 30 billion, whatever the case is, what is your serviceable addressable market? Serviceable addressable market is basically, that is, if they're saying in the world it is basically 30 billion or 50 billion, they are currently servicing the Indian industry. If it is let's assume it is a fantasy sports gaming companies are doing really well right now. Dream 11, you talk about these Adda 352, or you talk about latest Crick Pay by the Ashneer Grover, the well-known famous entrepreneur and shark. Even Paytm First Games is into it. So those kind of things you can ideally look at, that serviceable addressable market kitni hai aapki, what kind of areas, what kind of geography you are currently talking about. Come serviceable obtainable market. Now, when serviceable addressable market is maybe India, what is the serviceable obtainable market? Obtainable market is what kind of market share you can ideally take in this industry. If you are saying you have a serviceable addressable market out of 30 billion, it is 10 billion. Out of 10 billion, you can take a percentage market share of maybe 20% at max. You cannot have a duopoly in this industry. You cannot have a monopoly in this industry. You can, because number of players who are already in, they may be having a kind of market share already. You cannot talk about their market share. You would ideally be talking about your market share, which you need. So it may be 5%, 6%, 10%. That could be serviceable obtainable market. So that is the top-down approach. It could be bottom-up approach of how many number of users will you increase, how many number of paid users will you increase, how many number of games will you increase, how many number of tournaments will you increase. So that can be bottoms up approach. Then comes a top down approach. So these things are very important. You also talk to them about CSE, which is customer acquisition cost. You ask them that what would be a general customer acquisition cost for a startup ranges between 300 rupees to 700 rupees. Why? Because if you spend like 2000 rupees on an ad, which is the return on ad spend, you will ideally have around 100 odd customers who will reach your website. So this has been an average in the industry, which I've seen. Now, after reaching your website, if they convert or not, that's a separate thing altogether. So your return on ad spend can be on the side of revenue. that if you are spending 3,000 rupees, you are getting paid users of, let's assume, 30,000 rupees. But if you are spending 3,000, how many number of users are coming in is also a return on ad spend. So those kind of things you can ideally ask the customer. You can ask the client about that. What is the total addressable market, serviceable addressable market, serviceable obtainable market, customer acquisition cost, return on ad spend. Those kind of things are very, very important. So projection is a very important pillar to look at. You need to look at common sizing. You need to look at year-on-year growth. You need to look at industry trends. There's another. I'll give you a small. Then I'll go to the next pillar in that case. Company capacity is also very important. I've written it, so I'll talk about that as well. So recently, a company came to me and they said that we are a very big FMCG product manufacturer. So I asked them, how many products do you currently do? They said, we do 3 products per se. So I said, what is the, so they were actually showing 40%, 50% growth year on year. And the capex was very low. That triggered my mind. And I said that you are already doing wonderfully great. You are already a funded company. You already have 2 plants running. So it means your one plant must be at 100% capacity because you've started another plant just adjacent to the old plant. So they were like, yes, that plant is 100%, the capacity utilization of that plant is 100%. So I came to the next side of the question and I asked them, what is the capacity utilization of the next plant? They said, oh, wonderful. We are doing so great, Gaurav. We are already at 70% capacity utilization as the second plant. There I caught them. And I asked them that if your company is already doing around 80% on an average, 100 plus 70, 170 divided by 2, if you're already doing approximately 85% of the capacity utilization, and you're talking about 40% growth, are you talking about trading numbers? And if you're talking about trading numbers, that is maybe you're taking a white label product and you are relabeling it. Why is the EBITDA not moving in that case? That is the first question. You're currently doing EBITDA margin of maybe 7% to 10% or maybe 20%. If you're doing trading, your EBITDA margin should ideally decrease because that was the reason because of which you started with manufacturing entity, because trading was giving you less percentages, because any company who's into manufacturing would have done trading at some moment of time. So you ask them what were the trading percentages you were getting in the EBITDA margin, they'll ideally say it was 15%, 12% kind of a number. But when you're doing manufacturing, you're doing 20, 25% because you actually need return on capital employed. So your return on capital employed should always be higher than the return on the trading which you're currently taking. So that was not being taken care of. Then I asked them, are you putting up new machinery? They said, yes, we'll be putting up new machinery, but that's not reflected in the capex. So that is when you talk to the client and you make the value yourself as well. If they give you a projection and you just start working on the valuation, just send it to them, that will not make the client happy. Then you are again doing those things which are not adding value to the customer. So like, for example, a person who has an income of 2,50,000, it is important for him to get an income tax return file. But are you adding any value to him? You're not adding any value to him by just doing a income tax report for them, income tax return for them. So don't be that kind of a professional. Don't be that kind of a person which they say that is not adding any value to us. He is doing valuation, but what kind of valuation is he doing? I'm telling him the number, I'm giving him the projections, I'm telling him how to do it, and then he's just signing it across and sending it across. You will not add value to it. You will not earn revenue there. You will not earn fees there. You will not earn professional fees there. You will not earn respect there. Where you will earn respect is when you will talk about their projections to them. If you go back to them and you ask them, sir, your projections are not doing well. You are not doing as per the industry. Your numbers are not as per the industry. Your numbers are extrapolated or underdone. In those cases, they will come back to you and they'll say, wow, you have added some value to us. You have done something good for us. Thanks a lot. We will change our projections. And if they change projections because of you, mind it, they will come to you every year to get the valuation done. Every quarter, they will come back to you. Every time they will come back to you. And not just for projections. They'll come back to you for management information statements. They will come back to you for maybe other assignments as well. Our organization has seen a lot of times that the people come into transaction advisory, wherein they come in for due diligence, they come in for valuation, they come for M&A tax, but then they delve into other ECFO services like GST, income tax, and those. So while you're doing your work, valuation is one line which you should be working upon. There are few cases wherein people are not doing valuation themselves. You can take help from various experts available in the market and get the work done and send it across to them. But do not do valuation if you don't know it. That's first and foremost thing. Second is, if you know the valuation, check the projections because you know how to do valuation. But what is important is checking the projections. Even if they are giving you less fees, even if they're giving you more fees, whatever they are giving you, whatever time frame they're giving you, tell them first I have to check the projection and then I'll talk about. So the first pillar which I talked about is projection, very important. There are two kind of free cash flow from firm and free cash flow to equity. In the projections also. Once we do the projection, then we come down to a discounted cash flow method. In the discounted cash flow method, I'll just open a yeah. So discounted cash flow method talks about two kind of uh, free cash flows. So that is what we need to do. So the free cash flows maybe are going like these over a period of time. Then these are free cash flow to firm. So there are two kind of cash flows which people talk about. One is free cash flow to firm, another is free cash flow to equity. What is free cash flow to firm? Let's understand word firm. Important word is firm and important word is equity. Free cash flow to firm is basically that what cash flow is available to the overall firm. Overall firm means that is available to the all the sources of funds which are available with us. There are two kind of sources of funds which we all know, that there is equity and debt. So if there is free cash flow to firm, in that case we will not adjust for the interest repayments, we will not adjust for the net debt issuance, we will not adjust for new money coming in through the debt. So those kind of things we will ideally not talk about in free cash flow to firm. The most used method of discounted cash flow is free cash flow for firm, because it normalizes a company from any anomaly the company may have. Let's assume I am doing a business, I am running a business of toffee manufacturing, and you are also doing a business of toffee manufacturing. Your company may be levered. By levered, I mean that your company may be debt ridden, and maybe my company has no debt in the company per se. So in that case, when my company is a debt driven, is a non-debt driven company, your company is a debt driven company, when you will do your valuation through free cash flow to equity, you will have a different valuation. When I will do my valuation from free cash flow to equity, it will be different valuation, because I will not have any debt repayments, I will not have any these interest expenses, I will not have any debt infusion in my business, in my free cash flow, but you will have all those things. So your valuation as for free cash flow to equity and my valuation through free cash flow to equity may be different. But my valuation, that is, I'm talking about enterprise value. Equity value may be still be same, but enterprise value will be different in your case and in my case. Then comes to free cash flow to firm. Your valuation and my valuation will ideally be same, should be ideally be same. If you are doing what kind of business I am doing, you're also doing similar kind of revenues, you're also doing similar kind of EBITDA, everything remaining constant, your valuation and my valuation should ideally be same. But if it is not, we will look into what other reasons are there there may be geographical reasons, there may be other reasons for that. So when we use free cash flow to firm, in that case, there is weighted average cost of capital, which is the discounting method we generally use. In case of free cash flow to equity, we use cost of equity, that is KE, we use while we do the valuation method through free cash flow to equity, free cash flow to firm. So projections, first we have talked about that, how do we do the projection, how do we talk about them, how do we analyze the projections and things like that. Then comes the next is free cash flow from firm, free cash flow to equity. So those kind of things generally happen in how do we do the valuation in that case. Generally, I would suggest go for free cash flow to firm. It's it's not that subjective. It's not bad. It's basically dependent upon the company's movement. So it is ideally better to do free cash flow to firm rather than doing free cash flow to equity. But in your case, if your company is delving upon that, they have a lot of debt movements. The debt movements are very important in the company. Then you can go for free cash flow to equity. There are few companies where you have to go for free cash flow to equity, which is NBFCs or banks. When you do that, because debt and cash and interest payments are the core of the business. So you cannot do free cash flow to firm in those cases. So you need to do free cash flow to equity in those cases. And so specifically, if you're doing any NBFC or a bank or a fintech company, wherein debts and giving of debt and taking of debt and those kind of things are quite an operating thing. It's not just a source of revenue. It's not just a source of fund. It is actually the basis of doing the business. Then you should go for free cash flow to equity. Otherwise, try going for free cash flow to firm, which is, according to me, is a better option available. Then coming forward is the second pillar, the very important pillar is the discount rate. So I'll be talking about a weighted average cost of capital. Weighted average cost of capital is basically divided into two things. One is cost of equity, another is cost of debt. First, we will talk about cost of equity. How do we do weighted average cost of capital? So what I'll do is I'll show you a back model which we generally create. So how do we do? So I'm talking about a gaming company. There were not much gaming companies available in the industry in India. What I did in that case was I went to do some screening and I got these many companies all together to do the valuation. So I had to first remove all the companies which were EBITDA negative, who were doing losses, who had very low beta, maybe 0.5, whose business were not similar to ours, because we were uh, ideally into kids gaming, and let's assume, and they were into fantasy gaming, they were into casino, they were into betting, they were into those things. So kids don't do that, so we don't consider those kind of gaming companies in it. Then companies who had equity zero, who had low beta again, who had negative beta, who had negative EV. There could be companies who are having negative enterprise value. There could be companies who are, net income is less than zero, and there are companies who have no revenue, who are not in range, not similar business, revenue low. So what we did was we looked at these companies all together, and we got to know that these companies are something which we don't need to look at. So we removed all those companies from the list. So if you'll see, approximately there were 1,000 odd companies over there in the set. So we had to remove the companies first. Basis very, very basic things. So we did that. And then we went to the rest companies available. So first I put why to everyone. I am very, kind of a person who's very inclusive in the things. I consider all companies as comparable company. Even if it is 1,100 companies, I'll be very happy to see 1,100 companies moving alongside my company. But we need to ideally go back and check whether they are actually a comparable company or not. So we went back and we got to know that these are few companies: W Game, We Made Play, M Game Corp, Com Tours, G5 Entertainment, Me Too On, Rovio Entertainment. It's very important. One more thing is very important. You should look at some company who is doing India-based business also. In India, Delta Corp is one, which is a gaming company, but Delta Corp has its exposure more towards the casinos. It is a gaming company, but has casinos. If you go to Delta Royale in Goa, if you've ever been to Goa, definitely in a valuation standard board presentation, you would not like to talk about Goa. But yeah, when you're talking about gaming, you can talk about Goa for sure. So when you talk about, there was Delta Royale that is owned by Delta Corp. So wo Deltin Royale, that is basically a gaming company in India, but that was not comparable to us. So Rovio Entertainment, if you've heard of, it's basically that Angry Bird game which we generally have played in our, when we were young, or you would see in some movies of Angry Game. That is Rovio Entertainment. Then M Game Corp and We Made and W Games. Those were few companies which we looked at. Then we went to their comparable companies. We looked at what kind of EBITDA margin these companies are currently having, what kind of revenues these people are having. They're doing a good EBITDA margin of 23% to 17%. So we did a benchmarking on these EBITDA margins, and we saw that whether our company is doing similar kind of work or not. So we took those kind of comparable companies. We took some total debt, total equity. Then we went to weighted average cost of capital. See, while we do the weighted average cost of capital, the first and foremost thing is looking at the screening and the comparable companies. I'm doing a very, very practical thing here. I'm showing you a live valuation, which I've done very recently. It was done for March 23, and we've done things like that only. So we looked at these companies, we looked at their debt, we looked at their equity, we looked at their average or median debt equity ratio. So that is where we looked at. Then comes beta. Now, beta is a very, very important thing to understand. I'll give you a very small example to make you understand beta. What is beta? Beta is the one number which actually runs the whole valuation. There are other numbers also which runs it, but weighted average cost of capital is basically dependent upon beta of the company, of the comparable company. So what you do is when you do beta, beta is what, like for example, if my Sensex is increasing by 10%, then Reliance would also increase by 9 to 10% approximately. So the beta of Reliance is 1 in that case. If the let's assume the industry is going, so Sensex is going back by 5%. What happens generally is when we, there is selling in the market, we generally go to gold, diamond, and those. So the jewelry stocks start increasing at that time. So those companies have a beta of -1, or maybe less than 1, or maybe something like that. Then there may be companies who may maybe running on their own. They do not have anything relating to the market or per se, because they are small companies. They're generally not affected by this. Mostly Nifty 50 companies, you'll find beta 1. You'll find Sensex BSC 500 index, you'll find beta around 0.8, 0.9 approximately. If you will talk about a gaming company, let's say, a gaming company, which is a listed, maybe Delton Real, it's a listed entity. If the Sensex is going up by 10%, it may be going up by 4% or maybe 5%, something like that. So that beta is like 0.4, 0.5. So those kind of things we generally look at. When we looked at the gaming companies beta across the world. So this is when We Made Play Company Limited was compared with Kosdaq. When M Game Corp was compared with Kosdaq, at that time, what happened? Sorry. So at that time, the beta came at 1.4, 1.0, 0.8, and like that. Then comes trailing 12 months market cap. So what we do is we looked at the market cap average for last 12 months, how it has moved and how the things have moved altogether. Now we unlever the beta. So bada technical, it's a very, very technical thing to understand. What is a levered beta and an unlevered beta? Levered beta is, you see, these companies have debt. Yeah. Your subject company may also have debt. This company has 15% debt, this company has 2%, this company has 17%, this company has 4%, 15, 1.5, 2.5. So the debt equity ratio is quite varied in this case. It's going from like 1.5% to 17% approximately, and your company may be at a debt equity ratio of 30%, or maybe your company is at a debt equity ratio of 0 to 100. Most of the startups, when you'll do valuation, you will find your companies will have maybe a debt equity ratio of 0%, because nobody gives debt to a startup in India at least. So there may be venture debt, optionally convertible debentures or compulsory convertible debenture, but those are not debt. Those are fully diluted shareholding pattern. They'll be covered, and that will be considered as an equity. So what you do is you first unlever the beta. How do you unlever the beta? Is this beta of the company is also dependent upon the debt which the company has, because let's assume a company which has a 40% debt and a 60% equity is less dependent upon equity and has a lot of debt available in the company. So if the Sensex will go up, this may not move according to the Sensex. This may move 0.4, 0.5. But there's another company who has 100% equity available. Sensex moves up, their shares moves up, so everything goes around. So they may have a beta of 1. So for example, we look at Com2us. This is at a beta of 0.8, but has a kind of a good debt equity ratio, 1.1, a good debt equity ratio. So beta is not comparable here. What we do is we first unlever the beta. For unlevering the beta, there is a very, very technical formula which I will not delve upon. You can go online and check what the formula is. You unlever the beta on the basis of book weights. What is book weight? Is debt and the book value of the equity, and then the market marginal tax rates which you can consider. Marginal tax rate generally doesn't make much difference in the unlevering of the beta, but you can still look into different countries, different marginal tax rates. Then comes market weight. We generally consider the marginal tax rate of the subject company while we unlever the beta, rather than looking at the subject company, the company which you are valuing. Rather than the comparable companies. But you can also consider marginal tax rate of comparable companies. That's also acceptable as a norm. So then another option is market weight. So one is book weight, another is market weight. Based on that, we do a difference. So market weight is the 12-month market cap and the debt. So you do that, and then comes debt upon debt plus equity market weight that you get to know, and then you get to know that your unlevered beta is 0.98. Now you need to relever the beta. Unlevered beta means now this beta of all the companies, average and median, is of a company which has no debt. So if, for example, Com to us had no debt, which is currently 0.8, would have been 0.74 or 0.69. If the company had 2.5% of debt equity ratio, you'll see the most of the unlevered beta is also similar because it is same 1.0, 1.01, 0.74. So you'll see this beta is moving a little. This beta with the debt equity ratio is not moving that much. If you'll see this one 1.1 to 0.97, this has moved a little. So ideally there is a movement of 10% in this. So that is good thing to see that there is a movement in the unlevered beta. Now you need to relever the beta. So beta unlevering, first you removed all the debt from the company, then you relever the beta. Now when you relever the beta, there's another formula to relever the beta. For relevering the beta, what you do is you look at the debt equity ratio. There are two ways of looking at debt equity ratio. Your company may not have any debt right now because your company is not getting debt. It is not that your company does not want debt. Always remember, every company instead of raising equity would want to raise debt because the cost of debt is always lower than cost of equity. You can always pay debt back at a rate of maybe 14, 15, 7, 9, whatever percentage you're getting. But a cost of equity may range not less than 18% to 25% or 17% to 25%. So cost of equity is always higher than cost of debt. So whenever anyone asks you and say that, should I go for equity infusion or should I go for debt? Tell them that if you're getting debt, go for debt. Why you're not going for debt? Debt is a good source of fund than equity, in my viewpoint. Though it comes with its own riders of having a tension of paying it back, repayment, and those kind of things. But if you are having the opportunity, you are having the possibility of repaying the debt, you should always repay the debt and should have a debt in your sources of fund rather than the other. So then comes debt equity ratio. So what we did in this case was, because our company had no debt equity ratio as of now, we chose the industry debt equity ratio to relever the beta. So what we did was we chose the industry unlevered beta, we relevered it to industry beta, and we got a beta of 1.01. So you'll see this beta is different from the levered beta, which we have was 1.06 and 1.08, and this was 0.98, 0.99. So three numbers of beta we have. One is the levered beta we have 1.06. Another is the unlevered beta, which was 0.99. Then we relevered the beta at 1.01. So this is a very important process which you need to follow while you use beta. Now, a lot of people, what they do is they use a beta of 1 and they say there was no comparable company available, so we used a beta of 1. Don't do it. Please don't do it. You should not do that. 1 beta, you're just saying your company's beta is 1. It means that you're saying your company will move alongside what the industry will move. That's not possible. If the comparable company is not there, take the industry. Every company belongs to some industry. Every company has something to take care of. There are a lot of deep tech companies. I did a valuation for a company. I'll tell you the business, wonderful business. They were minting the NFTs, various, painting. I'm talking about very different kind of valuations here. Though I've done a lot of factories, I've done a lot of manufacturing entities, but those are very common valuations. So I'll talk about this business. What they were doing, they were minting a lot of paintings through Mint as a website, and they were going on a metaverse. So what they were doing is they were going on metaverse. They were doing a presentation. They were doing an exhibition on metaverse itself. From the exhibition on the metaverse, they were people were going in their avatar in the metaverse, and then they were buying through USDT. That is the cryptocurrency they were doing. That kind of valuation you don't find generally in the market. They came to me and told me that, Gaurav, I'm getting funded. Obviously, you'll get funding. You're doing something great in the industry. You will get funded. So they came to me and said, we want the valuation to be done. So I was amazed. Where do I get a valuation? These kind of company which is doing cryptocurrency, metaverse, uh, मेरे को समझ I'm taking time to understand the business 3 times. I told them, please make me understand again, please make me understand again. And then they told me, Gaurav, try and understand NFT first, try and understand this first. This was like 3 years back. And I was quite daunted to see this kind of valuation. And then I looked at the industry. So I saw there are companies in US, there are who have started accepting cryptocurrency, who are in the IT sector and started accepting cryptocurrency. So, and they are doing dealing in cryptocurrency. That was one option available for me to look at the beta. So I looked at those beta. The beta were coming at 2.4, 2.3. I was happy that I got a beta of 2.4, 2.3 because these companies are something which is, cannot have one beta. So then I went back and looked at those things. So these kind of valuations will also come to you. Don't say there is no comparable company available, hence you've considered beta. If you are not having any beta, don't do discounted cash flow. There are so many valuation methods available other than this. Go for comparable transaction multiple. If you're not finding a beta of any company, you can ideally go back and see that there may be another cryptocurrency company, there may be another metaverse company. There is a company known as Meta Dance, which recently got funding for around 5 million or 7 million odd numbers, $7 million. Why they got funding is because, and they have no revenue per se. So how do you do valuation through projection when they have no revenue? And when I had a word with the founder as well, founder was basically saying that I don't want to earn revenue for another 3 years. I was like, how will you do the business? He said, by the funding itself, because I'm generating users right now. And once I've done with the users, then I will go for the funding. So I'm looking for 1 million users at this moment of time. Once I'll have 1 million users, then I'll go for monetizing them. So monetizing is a word used in the startups, which means that you're starting to generate revenue. You're monetizing over the thing. Like, for example, I took this pen, I have generated 15 pens as of now, and I have not sold these pens right now. I just created these pens. So what I will do is when I'll start selling this pen, this means monetizing the sector. So I'm monetizing the product now. So they will monetize it afterward. Those kind of things are there. So not going deep into that. Coming back to the levered beta, we've done unlevering, we have done relevering. We came back to that. Then we go to risk-free rate. How do you get risk-free rate in the market? Generally, the risk-free rate should commensurate to the period of the company. So in India, the risk-free rate is generally available because the company, subject company was in India. We chose the risk-free rate of India itself. So the risk-free rate in the country is maximum available for a 10-year bond, generally available for 10-year bond. There may be 20-year, 25-year bond also. But government's most important bond is 10-year bond. So we go to risk-free rate 10-year bond, we go to RBI. Sometimes when you're doing a current valuation, maybe 31st May or if you're doing June valuation, people ask you for 5th June valuation also. In that case, the number may not be available on RBI website because RBI website does weekly updation of the RF numbers on the ratio and rates area. So if anyone wants to understand where do you get that data, I'll help you out in doing that. But there are also alternate options available like investing.com, wherein just put 10-year government bond yield, you will get those numbers. Always use 4 days or 4 weekly numbers for averaging the risk-free rate. So like we do, you do risk-free rate 7.49, 7.59, 7.55, 7.49, 7.53 is the number you get. Then you get the risk-free rate of 7.53. Then come market risk premium. So just give me a second. Thank you. So market risk premium. Now I'll tell you what WACC is. Very simple. So what is WACC? Let's assume you have let's assume you're investing in a company which is into gaming sector. We're talking about gaming sector. Let's talk about that only. You're investing into a company which is into gaming sector. You tell them, they tell you that we'll give you returns of some number. You just invest into a company. You'll say, listen, Gaurav, you are running a gaming company, right? It is a very risky proposition because it's not a very matured business as of now. Sensex gives me a return of, let's assume, we are talking about here, S&P BSE 500 index was at 1000 at that time, 21,325. It gave 13.5% of CAGR for last 24 years. It has given like that. So Gaurav, 13% का तो मैं return लूंगा ही लूंगा. That's for sure. Because If I am investing into something less risky, is S&P 500, BSE 500 index, which talks about 500 Fortune 500 companies of India. I'm not talking about Fortune 500 companies of the world, but Fortune 500 companies of the world of India is giving me 14% return. Gaurav, I will take minimum 14% return. So I said, okay, you'll take 14% return. Then they come to you and say that, your company's beta is ideally much higher than the companies who are in S&P BSE 500. You are much more riskier than S&P BSE 500 index. So I will add a premium to you, which may be 5% or 6% as a premium. I will add that to you. We'll talk about premiums in detail in further section. So you'll talk about that. Then he will say that, okay, going forward. So first we talk about risk-free rate 7.53. Then market risk premium. Market risk premium is what a person will earn over and above the risk-free rate. अगर आपको you want a very simple, you want a very safe investment, you go to government bond, buy the government bond and get 7.53, you will get 7.53. That's it. If you want a market risk premium, go to 6%. That's a premium which you're getting in the market for taking the risk. That's there. Then comes a levered beta, which we got above, levered beta. We multiply the market risk premium. This method is known as CAPM method. So CAPM method, cost is a pricing method. So now wherein, you look at these 1.01, then 13.6 is the base COE. Then there are some discounts which we need to add to it. Like, for example, discount for lack of marketability. Now, what is discount for lack of marketability? We'll talk about in the further section. What is discount for size and margin? We'll talk about in the further section. We get an implied beta of 1.81. Then there is a cost of debt involved in the company. Generally, there was no cost of debt available. So what we did in that case was we looked at the industry. What would, if they go for taking loan, they'll get the debt at 14%. 14% debt will have the effect of the tax benefit also. So that comes down to 9.1% cost of debt. Then we do a weighted average cost of capital of 18%. You'll see the company had just 3% of debt. So the weightage of debt was very low. So basically the value will come out from the cost of equity. So hence the value came out, the weighted average cost of capital came from 18%. So the most important things in the weighted average cost of capital, you will see are the RF, yield to maturity of 10-year government bond and security issued by Government of India, market premium based on overall returns of the stock market less RF, adopted beta of comparable company after considering adjustment for company specific factors. You go to cost of equity and then you go to WACC. Then you go to cost of debt, which is cost of debt for the company considered corporate tax rate of India. Then you go to WACC rent rounded, that is weighted average cost of capital. There are ways to talk about cost of debt also, but that is too big as a discussion per se, which we will do in some other session for sure. But cost of debt can be taken out from bonds, it could be taken out from the banks, it could be taken out from LIBOR rate, it could be from FIMDA spreads, so it could be on the risk-free rate, it could be on a lot of places. So we'll talk about that in some other session. But today we'll talk about cost of equity, how the WACC is being derived. So we have already talked about two pillars of discounted cash flow, which is projection and discount rate. So discount rate, it can also be, as I told you, in free cash flow to firm, we use WACC. In free cash flow to equity, we use cost of equity. So if you have cost of equity, you can use cost of equity. If you have WACC, you can use WACC. If you have, maybe there are other discount rates also, yield discount rate, there are other discounts also available in the market. Now we talk about discounts, which I was just talking about, that is minority discount, control premium, discount for size and margin, and discount for lack of control. These discounts and premiums can be added on the enterprise value or can be added at weighted average cost of capital. Please understand, it can or be done. So do not add discount for lack of marketability at there is one. Yeah. So do not put discount for lack of marketability at the WACC also, and also at the enterprise value also. Do it at once only. So what is different discounts which you put in? Minority discount. So let's assume I am investing into one company and I'm getting just 2% or 1% of that company. My valuation versus, let's assume Ayushri, who is the moderator here, is also investing in that company, but she's investing for 25% of the company. The the value which she will have, the things which she will have will be much more than what I will have. She will have decision making power. She'll have the influence to talk about the board. She will have influence to talk about the decisions and things like that, which I will not have. So if she is getting shares, she should ideally get at a control premium, which is, let's assume the company's valuation is at 100 rupees. I usually should get the valuation, should get those shares at 125 because she has other benefits also entitled to it. Whereas when I go for the valuation, I should get it at maybe 90 rupees. In that case, if 100 rupees is the valuation, I should get it at 90. So that is known as minority discount in the valuation. So whenever your company comes to you for valuation, ask them that what kind of share are you currently looking at in this business? Because whenever you do valuation, you do for a purpose. You do not do a general valuation. And when you do a valuation report, in the scope and limitations, you write that my valuation is for such purpose only, should not be considered for any other purpose, because my understanding is for this purpose only. If I go to a valuer, he'll give me a valuation of 90. If I usually go to that valuer, he will give the valuation at 125 because she will have control premium. I will have minority discount. So my WACC may be, because I have minority discount, generally, if I have 1% stake in the company, I go back and I want to sell those shares, people will generally not buy my share. They will say you just have 1%. If I usually go and sell her share, they will say, okay, I'll be very happy to buy. I get 25% of the company. So she has more marketability also. I have less marketability also. So hence my weighted average cost of capital, I would want a 30% return. I usually may be happy at a 25% return because she say that my share is more marketable. I don't want much things. His share is less marketable. He would want more things. So there is a discount for lack of marketability which is entered there. Now, discount for lack of marketability is just not about 25% or 5% or things like that. It's also about an unlisted company. You are investing into an unlisted company, and I am investing into a listed company, let's assume. While you talk about an unlisted company, your share to sell will be very, very difficult. You cannot just sell those shares very easily. For doing that, you would have to go back to the maybe gray market to sell the unlisted share. If a share is not demat, you can never sell it. Or you would have to go to VCs, PE funds, and things like that, or maybe angel investors to find for to sell your share, but you will not be able to sell your share very easily. And then there may be writers over your share that there may be a ROFR, right of first refusal or right of first offer available, that whenever you're going to sell someone, you need to come to us, inform us, and then you can sell. So those kind of things are there in a lot of places. Then comes discount for size, margin, and business dynamics. Discount for size, margin, and business dynamics are basically that the comparable company which we are talking about may be at a revenue of 10,000 crores or maybe 15,000 crores, maybe $3 billion of revenue. Whereas my company may be at 100 crores. So if I'm considering their beta at 1.1, my beta should ideally be 2, or maybe it could be 1.5. So that kind of discount for size and margin. So what is the range of these minority discount, control, premium discount, discount for lack of marketability? There are a lot of studies which have been done already. So we don't have to do those studies. There are Finnerty model available of discount for lack of marketability. That's a very different thing to do. Control premium also, there is a model to do that. But generally, the range is between 10 to 25 for minority discount. Control premium goes from 10% to 33%. Discount for lack of marketability goes between 20% to 60%. And discount for size, margin, and business dynamics go from 25% to 50%. So that actually talks about the valuation which we generally do. So like in this case, we did a discount for size and margin for 15% and discount for lack of marketability for 20%. So that can be done really well. So there's no problem there. Yeah. So we've talked about 3 pillars, rather 2 pillars, which is, talking about the projection. That is the first pillar. Then we talked about the discount rate. Now comes the terminal value. So I'll show you what terminal value we talk about. So if you will see, the present value of discrete cash flow is coming 2792, and the present value of terminal value is coming at 4890, which means that if you do this, this divide by this, you have 60% of the value coming in from the terminal value. So this is a very, very, very important thing to consider while you do a terminal value valuation. Terminal value, first we'll understand what it is. So what happens is, you cannot have projection for the life of a company. You can have it for a explicit period, small period only. So for a small period, you have, let's assume FY 24, 25, 26, 27, 28 kind of a number. You will have those terminal value numbers. So uske baad, the company may come to you and say that we will run at a terminal value growth rate. Now, what is a terminal value growth rate? Terminal value growth rate is basically the movement of the country's GDP per se. If our country's GDP, nominal and real, are going between 4% to 7%, our long-term growth should also be 6%. It should also be higher than the inflation of the country. If the country's inflation is around 5%, it could be around 6% so that it beats the inflation. That's it. Or it should be able to cover. So revenue would always increase by 6% in the perpetuity. Why? Because the country's inflation rate is such that if it doesn't, the company will decline. So hence the TVG is basically dependent upon the inflation rate and the gross domestic product percentage growth rate. So economics is very important in valuation. So TVG comes there. Then comes the operating expenses. So the TVG, revenue will increase by the TVG. Operating expenses will increase by this. Then comes the EBITDA number. So EBITDA number will ideally be percentage of this. Talking about depreciation and fixed asset movement. See, I'll talk about fixed asset movement first. Fixed asset can be so there are two type of fixed asset movement. One is a growth capex. What is a growth capex? Growth capex is like, for example, I was talking about that company which was doing FMCG product, which was doing 85% of the capacity utilization. If you remember, they said that we will grow over a period of time. So it means that they will invest, let's assume 100 CR more to develop another business. So if they're doing 100 CR more to develop that business, that is known as growth capex. Now, for example, we all run CA firms. We work in CA firms, we work in corporates. Yeah. Hamare office, what happens is there is one chair which is getting toned off. So what we do is we remove that chair, we get another chair. That is maintenance of the office. That is not known as growth of the office. If we are adding 30 more employees to our organization, God bless all of us, we add 50 employees every year, every month, and we add 50 more chairs to our office. In that case, that is known as growth capex. So 50 more chairs added from the current chairs is known as growth capex. Just removing one chair and getting another chair is known as maintenance capex. So when you're going in terminal value, it is always maintenance capex. In other year explicit period. So this is known as explicit period. What the period the company gives us as projection is known as explicit period. This is known as the terminal value. So when you're talking about the terminal value, there you will ideally have maintenance capex. How do you know what is the maintenance capex? Maintenance capex is generally that. Yeah. So it is generally that we have 18 as a growth rate in the fixed asset. So that is where we consider terminal value. When we do the valuation, there are three methods to do that. There is Gordon growth method, exit multiple method, and H model method. I'll delve upon them very briefly because we are pressing upon our time as well. So Gordon growth method is used when there is increase in just, let's assume 5%, 6% overall growth. H model is used when you have a movement in the company which is not stabilizing. Company was increasing like, let's assume 10%, 15%, 25%, 30%. It was growing like that. So it means the company is growing and the projection stopped there. So what we would have to do is it will gradually go down. So there is two-stage dividend discount model, which says that company is currently at 30%, it would have to go down to 25, 20, 15, 10, and then it will go to 5%. So what we do is in the H model, we use H model in those cases where the company is currently growing and the percentage between the 20% growth rate, let's assume they're doing 20% growth rate and 5% is the growth rate which is there in the terminal value growth rate, that will take some time. So we put H model there. Then comes exit multiple method. So exit multiple happens when, let's assume the company is not earning revenues, is not earning profits even in the fifth year. So how do you value a company in that case? The company is not earning profits in the fifth year. You cannot go ahead fifth year. Or there may be cases wherein, the company is having a very cyclical movement over a period of time. So what you do in that case, you do an exit multiple method. There are various other reasons also why you do exit multiple method. We'll delve into in detail in some other session. In exit multiple method, you just do EV EBITDA, EV revenue, P by BV, those comparable company multiple methods kind of numbers which you use. So in this valuation, I have tried using all the methods, whether it is Gordon growth method. By Gordon growth method, we were getting 6216. By exit multiple method, we were getting 5064. By H model, we were getting 9583. By CTM, we were using 3526. By CCM, we were doing 1424. So these kind of things, WAC was 19%, TVG was 6%, debt was this, cash was this. So we did a kind of a number. We looked at various, 19% as a WAC, 20% as a WAC, 21% as a WAC, TVG of 5%, 6%. You also do some trend analysis also you look at. So this is known as a trend analysis kind of a thing, that if the WAC moves like this, what happens? If the WAC moves like that, what happens? Those kind of things we do. Generally, if you see the GG model, there is a Gordon growth method model, you'll see the value is coming at 4890. It is basically capitalization of the last year's cash flow from the back and TVG, and then going forward in the exit multiple method also, you do, revenue of FY27 was available 12036, exit multiple of 0.7. We chose these companies as the comparable company, did some discount for lack of marketability, company specific risk factor. What we has used in the DCF while doing the back, we've used the same percentage discount in the revenue multiples also. So we done that. Then we came back to DCF exit multiple method. We did terminal value, cash accrual timing factor, discounting factor. You can also read about cash accrual timing factor. One very important resource which I wanted to talk about, which generally people don't know, is uh, a, a mine of information available by the god of valuation, which is Damodaran. Aswat Damodaran, everyone knows about, who is there in it. So he generally gives risk-free rates and betas for your comparable companies. So you can directly go to levered, unlevered betas available there on just India, just China. You're doing various countries valuation. You should not base your valuation on this, but you can definitely benchmark your valuation on this. That what is the beta you are getting and what is the beta which Mr. Damodaran is talking about. So you can consider that. Damodaran useful data set, you can Google it and then you can use it. Then comes after adjustments. Now, after adjustment is the last pillar of the valuation. It is a very, very important pillar to consider. Once your valuation is done, you get enterprise value from free cash flow to firm and equity value from free cash flow to equity. So these are two different things which you get. Now, when you get free cash flow to firm, free cash flow to equity, first and foremost is you divide it by EV, you need to come to equity. So equity value is equal to EV minus debt plus cash. That is the equity value, which means the value available to the equity shareholder, means enterprise value. From there, we paid the debt shareholders, and whatever the idle cash was available, we added that. So we told them, equity shareholders, this is the money which is available to you. So we gave them. So that is the equity value versus enterprise value. So first and foremost is cash and debt. Second comes as investment. If the company has any investment in any subsidiary, you would have to go to the subsidiary and do the valuation of the subsidiary as well. Like for example, I am currently doing a valuation wherein the company is in Singapore. It is a subsidiary of Indian company, and the so I usually is asking what, according to you, could be the gaps in valuing these recently listed
So we
fintech
will be
companies.
dealing with the queries
Yeah,
at the
okay,
end of the
sure,
session.
sure. So, investment, then comes debt-like items. So it's not just about debt. It is also debt-like items. There may be a lot of CCDs, OCDs, and things like that, which will have, the debt-like item available. Then comes lands and surplus assets. It is not just, sometimes companies like, for example, MTNL. What does MTNL do right now? Do you have phones of MTNL? Do you use broadband of MTNL? No, people generally don't have it. Few government organizations may have it, and if you call, they don't pick up. So the lines are just running. So what MTNL currently has is only land. So what they're doing is, VRS there, people are going through VRS and they're just selling off lands and paying the people. That's what's happening in MTNL's balance sheet. You go and look at it. That is what is happening at MTNL. So that is the surplus assets available in the country, in the company. So when you do the valuation of MTNL, there is no projection per se, which you have. Very, very little projections which they will have, and they'll say you the business is going off and those kind of things. But the value underlines in the land and surplus assets. So you add those surplus assets and land, and investments also you need to do value. Maybe you do it through NAV, to valuation, to discounted, CCM, CTM. That's another thing to do. So this is where our 4 pillars end, and that's about something about my organization. So I would now be happy to take questions, which Ayushri is putting across through our participants. So I'll just come back to the questions now. So the first, rather, we have a lot of questions. So I'll start with the first question. What, according to you, could be the gaps in valuing these recently listed fintech companies? So I have been part of those valuations, to be honest. Uh, these, gaps in the fintech companies. See, the problem was not with the fintech companies per se. The whole industry was going through like that. I had invested into Meta at that time also through one of the US based investment organization, wherein I invested $100, just $100 to check कैसे चलता है US industry. It went to $40 at that amount of time. So the industry was going bad at that time. Hence, the fintech valuation went down. Now, what is the wrong in the fintech companies' valuation is these fintech companies were coming from the mindset of venture capitalist firms. Venture capitalists come with the thought process of 25% to 30% return from one startup. They invest into 15 or 20 odd startups. They expect five will run, 15 will go down. That was the thought process which these fintech companies had. Not only fintech, startup companies I talk about. So they were there. So now while they were, getting valued, they were getting valued through venture capital thought process. We as an investor expect in 1 year 13% return, 15% return. Itna bhi aa jaye, we are very happy about it. So that was not the thought process there. So valuation was done with the thought process of 25% return. But when it got listed in the industry, people discounted it to get just 12% to 13% return. Hence, the valuation went down. It's just the talk about the WACC, which actually made the difference. Now, next question is how to calculate back in different scenarios with long-term debt, only equity, etc. See, how to calculate back in different scenarios, that is with long-term debt and only equity. So if the company is only equity, I've already shown you a company which was only equity. You can ideally use the market debt, which I used in the gaming company, which I just showed you that, we use 3% as a debt in the company. With long-term debt in the company, you should ideally, if you know that the company's debt equity ratio is not representable of the industry debt equity ratio, or the management also tells you that currently we are experimenting with the capital structure, you should consider the industry debt equity ratio while calculating weighted average cost of capital. You, on the other hand, if you think, and your company also, management also tells you that we will never be debt, we will never have debt, consider 0% debt equity ratio in that case. Generally, safest option and the best option is to consider the industry debt equity ratio. How to calculate terminal value? I have already delved upon that. And maybe this question was before calculating terminal value. I have told there are three methods to do it: Gordon growth method, H model, and exit multiple method. In 70% on my cases, I use Gordon growth method. In 10% cases, I use H model. And in 20% cases, I would be using exit multiple method. That's how the whole industry works. So next is company wants to issue shares stepwise within a year. That is 4 to 5 investor group in different valuation. How is the value of shares calculated and what are the risk associated or tax implication issue of share different valuation in short term period? See, I have done valuations wherein the company was at a $1 million valuation in the starting of the year. And by 6 months, it was at $20 million valuation. It can happen. There is no problem in that case. You know how this happens is the company got a strategic investor at the $1 million. So there was one company which was into the insurtech space. Yeah. They were getting one investment of $1 million from a strategic investor. Strategic investor was basically a person who had chains of hospital across the country. So for him, selling the health insurance was easier, much easier to do that. So what he did was that insurance company got $1 million funding, but the revenue increased $10 million because those companies had a lot of good exposure available around the insurance broking, selling, and those things. So the valuation increased within 6 months. Those kind of things can happen. If company comes to you now and says that I will invest, I will get funding at $1 million now, then $3 million, then $7 million, then $10 million. I'll tell you, there are various other options available in the market which can help them doing a non-price round. There are two kind of rounds: price round, non-price round. You tell them do a non-price round, which means there may be a compulsory convertible debenture, convertible at a certain percentage after the next round is done. So you can say you give them 10% discount for the next round. You give the next investor 15% discount in next round. You give the next investor 20% discount in next round. There you don't need to do valuation per se. Just that you need to give valuation of the instrument at a later stage. Option valuation, that is basically Black-Scholes and all. Will That is very, very different thing to look at. But you can have different valuations within single year. How do we ensure assumptions are accurate, ensure model is well designed to avoid inefficiency in arbitration? I've already told assumptions are accurate and not common sizing and things like that. I've shown you the presentation on the projections. You can definitely look at that. Industry trend. There are so many reports available, so don't worry about it. If you are there, again, at the end of the valuation, do not write you have checked the projection. So be safe in that case. Always write it was the responsibility of the management to give me the projections. It was the responsibility of that. I did not do any due diligence. I did not do any audit. I did not do anything. It was basically dependent upon the management. But you should always do your due diligence at your end, but do not write and take that thing on you, because tomorrow when the things will happen, it should be the company who is giving the answers to projections, not you who should be giving the answer to projections. Definitely, what happens in this case is also when I do valuation for a lot of listed, unlisted companies, wherein Big Four is the auditor, their valuation team also comes at the end of the year to review the valuation. So at that time, there's a lot of question answers and all of things on the projection. So it is better that you put those questions to the company rather than putting those questions to yourself. So assumptions check करनी है, are accurate or not, that's very important too. How do you compute weight of debt and equity while using WACC? How do you deal with circular referencing there? See, if there is circular referencing, there are a lot of cases in the projection. Also, there is circular referencing. You should consider circular referencing with some iterations for sure. There is no problem in that case. How do you compute weight of debt and equity while using WACC? I've already told you, I've delved upon that question in the last question also. And I've told how do you do the WACC. You can consider industry debt equity ratio. You can consider company specific debt equity ratio. Those two options are available. Generally, you should go for industry debt equity ratio, safest and best option available in the market. How to obtain master data to refer to find out discount rate. See, I told you Damodaran is one option available, but that shouldn't be used to benchmark. There are various options which are Bloomberg, Capital IQ, Capital Line. These are few available. Capital Line has one MOU with Institute of Chartered Accountants of India, which I am currently using. It is basically for the TP side. I have requested for the valuation side as well. I believe we'll have that very soon. But you can take that. That doesn't cost much on the Capital Line. You can get beta from Capital Line. That's for sure. Do not consider one ka beta. Please understand that. You can benchmark it to Damodaran. The best database platforms are Capital IQ and Bloomberg. They are costlier. I generally use Capital IQ as an option available. It costs you a lot, but it gives you good benefit. So you should ideally be using those. But if you don't get it, you can use Capital Line also. ICI has an MOU with them. You can go and buy the Capital Line through the ICI MOU. Where do we get the data of other companies for comparison to the trend and behavior? I told you Capital IQ, Capital Line. You can also do Yahoo Finance, maybe from newspapers, you get some information, but it's better you do it from that side. How do you compute the weight of debt and equity while using WACC? Ho gaya. How do obtain master data? Yeah. Both equity valuation done out of FCF and independently out of FCFE can be done independently and will give similar results. So how FCFF can be claimed a better one? See, FCFF actually removes all the anomalies of the debt the company has. This is my personal opinion. Ideally, I've used it while I was in Deloitte. I was in SS Kothari. I've seen a lot of, in my team, when I was working in Deloitte, there were people who were from KPMG. Char Dham Yatra to Big Four mein hoti hai. Everyone knows. So people were from Deloitte, from KPMG, from PwC. Everyone was there. So I have seen things moving around with all the Big Fours. I have friends in Duff and Phelps. I have friends in, Aranka valuation, wherein we keep talking about things. Whenever we meet, we talk about valuation, M&A tax, and those kind of things only, all the time. So I've seen most of the valuations are done on FCFF because it removes the anomalies. I would personally say go for FCFF. If you think you don't want to go for FCFF, go for FCFE. There is no problem in that. It is not a biased method per se, but FCFF gives a better valuation. WACC of the comparable company. How is it relevant in case of absolute valuation? absolute valuation, I didn't get a word, but WACC of the comparable company, WACC, there is no WACC of the comparable company. There is beta of comparable company, which creates the WACC. So question is a little different. Tax rate is relevant for unlevered method also for calculation of NOPAT. Yes, tax rate is relevant for unlevered method also. Yes, it is. While I told you that you can use subject entities, subject entities tax rate as well, or it is much better to use the country specific tax rate. Now, I'll show you another. I'll not be showing you because less of time, but I would have shown you on the Damodaran's website. You get a tax rate kind of a thing, country wise also. So you can just take out all the tax rates on the country wise and you can use that as a tax rate option available. Don't just Google and check all the tax rate. That is a KPMG's report, which KPMG's updates it on every yearly basis. And Damodaran publishes that KPMG report only. So you can use that as a tax rate for different countries. Definitely, if you are relevering the beta, you can use tax rate of those countries. What is different between levered and relevered beta? So I've shown that it was three different numbers. 0.97 was 1.01 was one number, 0.97, 0.98. So it's different. I've given a good thing. If in case you still have any query on beta, levered beta and relevered beta, I'll show my contact details. You can definitely look at that. How fair is to consider foreign companies beta for an Indian entity? See, it is very fair to use foreign companies beta for an Indian entity. There is no problem. Though world is one, consider that the whole world moves like that. If Meta decreases in US, our Indian startups also decreases with the same thought process. So you can consider those companies. There is no problem in that case. If the comparable companies are not available in India, go to abroad and do that. There is no problem in doing that. We have been doing this practice for a very long period of time. It is fair to use comparable companies as foreign companies for an Indian entity. But yes, you need to do a country specific risk premium. Those are also available on Damodaran's website. You can also do the economic analysis and then do the company specific. That is taken care in the discount for size, margin, and geography also. So that is being taken care of. CAPM. It is capitalizing pricing model. I'm really sorry for the Gordon growth method is to factor back also. Please explain that for the benefit of member. See, Gordon growth method is to factor back also. I have shown that Gordon growth method is divided by back minus TVG. So that's how the Gordon growth method formula is. So that is there. And then coming next is the H model and then the exit multiple method. You can use it. How to calculate terminal value for firm and equity method. So I've shown terminal value for firm and terminal value for equity is same. Gordon growth method, H model, and same it is. Regarding TV, what about companies which operate in region which have negative growth or very low inflation, 1% or so? See, inflation is not for the company per se. Inflation is for the country per se. There is no economy data which is available for industry for sure. There is industry inflation data available, but we generally consider the country inflation data. That's one. What about company which operate in region which have negative growth? So that has also been a case. I have done valuation with Japanese companies and things like that. There are different options available wherein you can consider 0.1 to 0.3 as a percentage of growth. You consider a long-term growth rate in that case. You see the GDP growth has been such which will ideally increase. So I did a valuation for Japanese company which was funded by SoftBank and Yahoo, and for that I considered a TVG of 0.1, though the country had very less. Even the debt, the cost of debt was also minus 1%. So we couldn't use cost of debt there. We did not use as a debt equity ratio. We used the cash. So there are a lot of subjective things which you need to look at and work upon. Can you please explain market value and intrinsic value under DCF? See, these are theoretical terms. We'll talk about them in a theoretical session going forward. So I think we have most of the queries resolved, and I apologize because of less time. I couldn't delve upon a lot of things in detail. I will do that in further sessions for sure. There are few words and few anomalies which I may have used wrong because of all the audience I have, all the people I have, and the aura you all bring in. Thanks a lot for being here. Everyone, Hansraj Chuk sir, thanks for giving me this dais. Preeti ma'am for giving me this. Ayushri for moderating this wonderfully great I kept getting few things here and there. Please speak in English. Don't use Hindi. So I'm really sorry for that. Thanks a lot. Rahul, thanks a lot for managing this thing really well. And the tech support, it's wonderful. You have done simulcasting for this platform, and I'm really thankful to all of you. I'm sure my session would have been informational, educational, and would also have dealt upon a lot of practical aspects of things. In case you have any query, you can reach out to me at, I'll just show my contact details for one. You can reach out to me, my mobile number, my email ID. I'm available at my mobile number, my email ID as well. So that is there. Yeah. Thank you. So off to Ayushri. Yeah.
Thank you so much, sir. You have actually given us a real insight of cash flow. And definitely, that's the best part, how you related it with what we have studied years back. It actually reminds us all of those books and studies and, solving questions. So if we are ultimately, I felt like, thank God I studied that, I'm able to understand it. Because I'm not personally a valuer, but
Yeah.
relating it with the real life and giving a real insight. Thank you so much for being here and sharing lots of examples. Your session was so informative. We can see the number of queries. And it is not the end. We're still receiving it, but apologies to the participants. We have short of time, and ultimately it's Sunday, right? So
Yeah.
looking forward for much more webinars with you, CA Gaurav sir. And thank you so much all the participants to join with us. And I hope the session was really productive and informative for you. Personally, it was really for me. So I'm believing for you as well, you have enjoyed it throughout. Thank you, Tech Support and Rahul sir. Good day, everyone. Meet you in the next
Thank
webinar.
you.
Thank
Thank
you.
you.
Bye-bye.